Good morning and welcome to the August 7th edition of the Gold, Goats, and Guns Market Report. My name is Tom Luongo. I hope you've all had a great couple of days. It's been a tumultuous couple of days since we last talked on Sunday. Got a lot going on. I want to give a quick shout out to all our new patrons. We've picked up a solid handful over the last couple of days. Very, very gratifying as always. I don't like to name names, as you guys well know, but y'all who have signed up recently, I do greatly appreciate it. And if this is your first time with us today, well, there's a wealth of these that go back a couple of years now. So and a lot of the concepts in these market reports, as far as my chart reading and style and whatnot, I've explained in the past, and I'll try to make sure that I do a good job of every once in a while doing a little refresher course for the new people so that it doesn't sound quite like complete gobbledygook. All right, just something I have to remind myself as I get better doing this, as always. It's like everything else in this life. You know, if you're not doing constant self-improvement, what's the point of living? All right, guys, let's get to it. So we've got a lot going on, a lot going on, and so much going on that I can't cover it all. And I wish I could, but I'd be here for 3 hours, and I don't have 3 hours today. I've got to finish up the newsletter and get it off to my partner and editor. I've got an article due for Strategic Culture. Otherwise, I'll be horribly behind for the rest of the week. You know, it's just one of those things. It's like every week is like painting a bridge. And then when you're doing this, and that's not a complaint. That's a good thing. I mean, honestly, if nothing was happening, I wouldn't have anything to do, and I wouldn't have anything to write about. And well, shit, I wouldn't have a business. All right, so let's do this. So last night we had a trifecta of rate cuts that were surprised. A couple of which were surprising across the board. One was New Zealand cutting by 50 basis points. One was India cutting by 35 basis points. And the other was Thailand. And Thailand was the big surprise. Because the Thai economy has actually been one of the strongest in Southeast Asia. And there's, especially with settling a lot of the political turmoil now that the military is no longer in charge. But this is something that happens in Thailand pretty regularly, as the civilian government fails and everybody has the military to take over because, you know, they're better at, quote unquote, making the trains run on time better than the civilian government generally does. It's always a fluid situation in Thailand, but it's not. But it sounds worse than it actually is, for the most part. Other than there's some breakaway problems to the south along the Malay Peninsula, but it's not as bad as that. For the most part, Thailand's pretty stable. I know a lot of people expat up into Chiang Mai area, but that's neither here nor there this morning. What's important is to understand that as much as Donald Trump doesn't like the rising dollar, he's got to deal with it. And he can't just keep blaming China for it. And he can't just keep looking at the China-U.S. Dollar exchange rate and then making policy decisions based on that when things are far more fluid than that, and far more complex than that. And unfortunately, Trump is not a particularly complex kind of guy. He's a very simple person. And it's going to be his undoing as president. I'm almost positive here. And that's a shame. I don't want to say that, but it's the truth. So the rate cut trifecta is nothing more than another instance of, or set of data points that the global economy is in real trouble. It is accelerating to the downside. I'm going to show you some charts today of what's going on in gold, oil, and silver. And if that doesn't, set the hair on the back of your neck ablaze, I don't know what will. And these are things that we all talked about. We talked about all these markets on Sunday except for silver. We talked about gold and oil and silver, and then, it's like I say something on Sunday and it becomes true on Wednesday, and it's really beginning to get kind of spooky. How longer-term market signals are becoming short-term market events, and that'll give you an idea of how quickly things are accelerating and how quickly they're going to get out of control, and how much I think the central banks and the regulators and politicians such as Trump are not prepared for it. Okay, so you can't look at everything through the simple lens of the U.S. of the yuan dollar exchange rate. It's far more complicated than that. I stress this point all the time that there are multiple tens of trillions of dollars in U.S. denominated debt out there that needs to be serviced, both domestic and foreign. And that's what's creating an upward pressure on the dollar, along with the fact that as the global economy slows down, and the global economy is as leveraged as it is, thanks in part to China helping to bail out the world after Lehman Brothers 10 years ago by inflating like mad and creating an asset bubble, which we fed into. Trump can complain all he wants about the trade deficit and offshoring jobs and all this stuff, but he's stuck in the 80s, for Christ's sake. He's stuck in the 90s, and this is not reality, right? And the reality is that the financial system broke in 2008, and if China hadn't exploded its credit system in response, while the rest of the central banks around the world printed trillions, tens of trillions of dollars, the global economy would have fallen into an abyss back in 2009. Now, it should have, but that would have been bad for the people who actually think they run the world, and therefore it wasn't done. And it was, in many ways, it was a coordinated effort. In a sense, the Chinese have just been sitting back going, okay, if you're going to give us all this money, we're going to use it to build infrastructure. We're going to use it to bring 1.3 billion people out of poverty. We're going to do this. It may not be sustainable in the long run on the current model, but that's what we're going to do. And we're going to do this for as long as you people are willing to pay us for it. Now, Trump is trying to change that dynamic, and I applaud that. Don't get me wrong. The problem is that China is not the problem. The problem's here at home. And I keep stressing this point over and over and over again. And I have to keep kind of coming at it from different angles in order to try and paint you the picture of what's actually happening. I've talked about it in terms of data. I've talked about it in terms of taxes and regulations and the expense of labor and everything else that we have here in the United States. I've talked about all these things, but let's get down to brass tacks. Without China's incredible credit bubble of the last 11 years, which was a result of coordinated central bank inflation, the world would have collapsed. And we wouldn't be having this conversation this way. So, is China the hero or the villain in this story? It's a good question. It's not that simple. Nothing's that simple. Everybody's guilty at a certain level. But more importantly, so with all that out of the way, and that's what's affecting credit markets, and that's what's affecting gold and equity markets and everything else, let's talk about what's going on in Syria. Because I found this picture this morning. The big headline for me this morning when popping through Zero Hedge and other places, just looking for the bullet points to talk about, because I get up at 7 o'clock and I sit down in front of the computer and I have a cup of coffee in my hand and I do the thing where I'm scrolling the headlines and trying to get caught up in what happened in the last 7 hours, because sometimes that takes 7 hours to get through. But this morning it was pretty simple. Turkey and the United States are at odds here over what's going to happen in northeast Syria. And the Turks are pretty much off the reservation, and everybody knows it. They bought S-400s. They told the United States they don't like the policy of us backing the Kurds in order to balkanize Syria. That, by the way, that policy is part of a much, much larger and longer strategic plan that's been in place, to be executed for 40 years. I mean, this is nothing new. The whole creation of an independent Kurdistan, and I use the word independent with tongue firmly implanted in cheek, because they're not independent; they'd be U.S. satraps. That would take a little bit from Iraq, Iran, Turkey, and Syria, or in the case of Syria, a lot, or in the case of Turkey, a lot, because that's where all the oil is. And so we want an independent, quote-unquote, independent Kurdistan that we control, that we can control the oil, and then we can starve everybody else. You can starve Turkey, you can starve Syria, you can starve Iraq, you can starve Iran. Okay? And Turkey's not happy with this. Turkey's not happy with the fact that we tried to have him killed in 2016. Turkey's not happy with a lot of things. And so Erdogan, the president in Turkey, president, dictator for life, whatever you want to call him, has had enough of that. And so when I was trolling for this picture between Erdogan and Trump today, I came across this one and I just laughed, because that smile on Erdogan's face is telling you everything you need to know. I'm going to invade northeastern Syria, and I'm going to wipe out the Kurds, and I'm going to invade Manbij, and there's not a lot you can do about it. And if you do something about it, then you have to kick us out of NATO. And if you kick us out of NATO, then we'll join the Shanghai Cooperation Organization, and all hell will break loose in the Middle East as we then become complete enemies of Israel, which at this point Erdogan already is. He's already made every statement imaginable that you can make. They've got S-400s, which are going to place on Cyprus while they drill for oil and drill for gas and control the Bosporus and the Dardanelles. They're going to be aligned with Russia and China and Iran. And the second largest ground force in NATO will flip sides if that's what Trump thinks he's going to get away. Trump's not going to do this. Trump's not going to stop Turkey from doing this. Turkey's going to annex parts of northern Syria. The Russians aren't completely happy about this, but they're going to do it. And they have to do it because they have to continue, because someone has to push the United States out of their position in Syria, because the situation in Syria is untenable. So the Russians and the Syrian Arab Army are pushing out Al-Qaeda and the rest of them in Idlib, all those Salafist head-chopping animals in Idlib that we're backing. Tulsi Gabbard is absolutely right about this, to bring this up in the debate stage. And our control of the Syria east of the Euphrates River and at Al-Tanf is unsustainable. So if Turkey continues to do what they're doing, it's just further data. It's just further advancement of the trends towards pushing the United States slowly but surely out of this region. Okay, and Trump wants some kind of drawdown in Afghanistan, but we want to leave all the bases there because what we want is to remove some troops that we're fighting the Taliban with, which we're not really. It's all for show, because remember, Trump put 8,000 troops in Afghanistan in August of 2017. Now he's going to pull 5,000 out. And oh, look, I'm the great peacemaker. Come on, pull the other leg, John, and plays Jingle Bells. Okay, what we want to do is we want a ceasefire with the Taliban so we can take all those troops and we can point them at Iran. Because that's what those bases in Afghanistan are for. The problem is that if you lose Turkey, you lose your resupply logistical point at Incirlik, and now all of a sudden you got to figure out where you're going to house aircraft now. You can do it in Jordan, you can do it in other places, but at the same time the Iraqis are getting tired of us being there as well. So it's all kind of looking like everything. We're getting close to that point. I don't know if it's going to be this year or next year or the year after, but it's going to be soon, where we're going to have an effect, especially if there's a financial crisis, that we're going to have a kind of Saigon pulling the troops, pulling the people out by helicopter out of the embassy kind of event in across Central Asia. And that's what Erdogan is smiling about in this picture, because I think he knows it. All right, let's get to the charts. I'll get you out of here. Let's talk about gold. Excuse me. A little liquid courage. Liquid courage. Liquid stimulation. Sorry, not liquid courage. Oh, that's a Freudian slip. Oh, God, I wish I drank that much. All right. My liver can't handle it. All right, so gold this morning, $1,500. Wow. Thomas, Jesus. All right. Gold this morning, $1,500. Look at what we got. We talked about this on Sunday, that gold had broken here. This is July, right? And what we saw was a really nice turnaround within the weekly chart. I didn't bring the weekly chart with me today because, again, I wanted to show you with the size and shape of the moves that are happening in gold. The weekly chart's kind of boring. It's look, it's a straight line up. And there's no context, right? It's more impressive or more important to show you the context of this move back to 1,500. We go back now. We have to go back to 2013 to see gold prices above 1,500. Once we broke through the strong resistance of the post-Brexit high at 1375, gold would go broke and feel running. And it's because of these monthly. It's because, one, of this monthly close, to this, which then constitutes a 2-bar reversal on the monthly chart, because here's your 3-month downtrend, and then that high is broken by this close above that high, which was done within 2 bars, so that constitutes a 2-bar reversal. If it was done this month, it would be considered a 1-bar reversal. These are each bars, and what we're looking for is a close above for changes in trend. Depending on the time frame, or doesn't really matter, you're always looking for a close above the previous high or low within that trend, either up or down. So in the case of a downtrend, you're looking for a close above that high. So this is a 1 bar reversal, even though there's a high tail here. It's still closed just slightly above that high. And so this 6-month downtrend, or really 8-month downtrend, was broken by this bar. And then we got a 4-month uptrend. And then we never got a close below, on the monthly chart, below this low. So this 3-month downtrend here would be considered a very weak signal and really kind of a consolidation period, and then was just waiting for and ripe for a reversal, because 1 and 2 bar reversals are pretty strong. 1 bar reversals have an 85% chance of signaling a new downtrend, and 2 bar reversals generally about 65%, and so actually make some money on them. Anything after that is less than a coin flip. 3 bar reversals incredibly weak, so don't use them. Consider them then at that point something like consolidation, and that you're going to trade sideways for a while, and then the market will decide whether it's going to break down or break up. But it's not because of this signal here. A 3 bar reversal would only tell you that you're either going to get a continuation of prices kind of within this general range, or a break higher or a break lower, and you don't know until it happens. And so you position yourself accordingly, waiting for some kind of breakout from the range itself. So this was our range. We got to break out above this high, which tells us, okay, now we got to look for this high. We got that high broken, and then we go back and we look at these we go look at these highs here, and we go, can we break those? Because there's a ton of them in here. It's tremendously strong resistance, and we did. The market was the bulls weren't committed to being above 1400 at first. Market overshot, as it always does. Short covering, panic, momentum, yada yada yada. But then the weak hands get out, the thing drops a little bit. People move money around to get out of the gold trade. They go, hey, I made enough money, and they get out. And we have this kind of thing. But as long as it's not closed below this line, then we can consider this resistance broken by the end of the month. We move on. And what was interesting in July, it was right towards the end that we got this signal, because we weren't going to get it, which was that we got this break above the previous high, which now confirms that this uptrend that this uptrend has still got room to run, because you're always looking for higher highs and higher lows. That's an uptrend. Just like in a downtrend, if you're short, you want to see lower highs and lower lows, right? You want to see those things happening. And if you don't see those things happening, you can't see, if gold refused here after this breakout to push above this high again, it would mean that it's not really committed to going to 1500 yet. It may take a couple of months to trade sideways before it does so. It may even want to retest, this area again, or possibly even retest, this low again, or something along those lines. But we might even get, a kind of, and again, it all depends on the kind of pattern it wants to trace. I don't do Elliott wave. I don't do any of that stuff. You'll notice I don't even do like MACD and RSI and all that other stuff, Bollinger Bands. None of that stuff to me matters. What matters at the end of the day is if you're really smart and you're really diligent, you can read the candles on the chart and you can see what's happening. That's why candlesticks were created by the Japanese during the rice trade of 1,000 years ago or whatever. They're really good at it, and they're really useful. But really, just keep it down to open, high, low, close. You'll notice there's not any line, horizontal lines marking out the hundreds areas or anything like that. Keep it simple. Keep it straightforward. That's what works best for me. At times, I'll use other things, but I don't use them often, and I don't like to. And that's only for price projection stuff. I'm not a big fan of that. Unless somebody asks me in general what I think about getting a price projection of where we're going to go, either in the short term or the long term, well, I'll give you some qualitative hand waving stuff. But for the most part, I just kind of like to watch it and see it play out. I'm much more interested in seeing breakouts on the weekly chart become breakouts on the monthly chart, which then become breakouts on the quarterly and the yearly chart. And then if that's the case, you just keep riding that trend until it reverses. And truth of the matter is that gold has been in a bull market since 1968. So from a yearly perspective, gold's been in a bull market since 1968, and it's not going to stop anytime soon because the central banks are going to continue to print money. And that's the short answer. The long answer is that there's a lot more money running around, and therefore we need to constantly liquefy it relative to gold. All right, so what's interesting here, of course, is that we got this break, which gave us the opportunity on beginning in August to see. We've already gotten tremendous volatility. You'll notice, I'll go over this stuff in just a second, but yeah, grabbing the 1500 handle here is really nice. I don't know that it will break through it here or anything, but this is the cash market, by the way. This is not the futures market. So this is the XAU versus USD cash market, because that's the only gold market data I can get on a regular basis that actually is consistent, at least with a free data package. I don't spend money on data packages, so I don't have a Bloomberg terminal or anything like that. If I was making that kind of money, I don't know. Whatever. I'm not making that kind of money. So just so everybody knows, for the professionals in the audience, they know what's going on. So we'll see if we can break through this $1,500 handle. One thing for the new people, gold tends to like to trade in round numbers. So every $100 is going to be every $100 is a headline. Every $100 is an opportunity for some lazy short to come in. Yeah, I'll short it at 1,600. Not looking at the chart, not thinking about it, just going, yeah, it's probably overvalued at 1,600. We'll set up shop there, and that becomes a self-fulfilling prophecy. This is part of the reason why I'm not a huge fan of classic technical analysis, because a lot of this stuff tends to become a self-fulfilling prophecy. I've gotten away from it. I've been doing this since the late 90s, and I'm just not down with it. So with that, I'm sorry, I promised you this. So let's talk about these things real quick. For those of you who you heard this spiel before, that's fine. But again, every once in a while, I need to update people. So difference between closes is really simple. This is just all I do here is on the monthly data. I have about 7 years worth of data. So over the last 84 months of trading, the average difference close to close is about $41, and the average range low to high on a monthly basis is 82.50, 82.66. So all that's saying is that's what we can expect. A normal average trading month is to see a difference between this closing price and that closing price be about $40. Now, right now, it's like $80. So this is a 2 sigma event, or 2 standard deviation event. But you can see, it's just to give you an idea to help you. I like to call these the volatility statistics. They're just really simple to give you an idea of how much you can expect a stock or a metal or whatever, bond, doesn't matter, to move. Currency, you can do this with everything. All I'm doing here is just taking open, high, low, and close, taking that data that's publicly available and then manipulating it in very simple ways. Okay? These percentages are based solely on having taken all that 84 months worth of data, totaling up and going, okay, and asking a very simple question. If gold moves a little bit, in this case, I usually put a quarter in because of the size of the move, just some non-zero movement in the up direction. How often will it, what's the probability that it'll go from where it opened here to break that previous high, right? That's all we're asking. 41%. And then to break the previous low, 49%. Same thing in the opposite direction. If it drops down 25%, there's an impulse down, what's the possibility it's going to drop down? Now, the other interesting part about it is that you can also then take that same data and start slicing it out and saying, well, if we've already moved, $18, say, down here, or $20 down here, we've only got another $5 to move to break that previous high. What's the possibility that we'll do that this week? And you go into the weekly statistics, put that in, and go, so we've already, we've opened this week here, and then you say the same thing. Well, it's 25 cents, and what's the odds that we're going to get a $5 move this week? 30%. Okay, I guess I probably shouldn't put some money on the table. What this is doing is giving you very strong, effectively pot odds. As if you're a poker player, you know what I'm talking about, as to what's going to happen here. So when we opened the month of August, there was a coin flip as to whether you were going to make money going long or make money going short. And so, if you're that kind of guy, you'd put a spread on with both a long leg and a short leg and close the one that failed. And it's this very simple quantitative way of looking at things. There are more sophisticated quantitative trading systems out there. I don't trade actively anymore. I do this mostly just to give you an idea of what I'm seeing and help me and you temper expectations and keep our emotions in check, because that's what these numbers are for. Okay, and it's just so that we can just read these charts with as blank an eye as possible. No rose-colored glasses, no black pills. Right. So looking at Bitcoin. So Same thing. I have some on the weekly chart now for Bitcoin. We're only talking about 134 weeks worth of data. I usually use 250. Usually try to use about 5 years worth of data. But Bitcoin doesn't have 5 years worth of data trading above $1,000 an ounce or $1,000 a piece, and therefore, the statistics at that point become kind of crazy if you're going to add in data that's where Bitcoin was trading $3 and it's currently trading at 11. That's not 11,000. That's not good statistical work. So every week, of course, we add to that data set and we keep going. So these data here are not nearly as strong as the data for, say, gold or silver or oil or the Dow. So, but what's interesting here is that we've had a very noisy move in Bitcoin for the last 1, 2, 3, 4, 5, 6, 7 weeks after this massive uptrend. And a couple of things to note, as I've said before, avoided a reversal signal here, barely, and then we got a big move higher. Avoided a reversal signal here by closing above this low. Then another huge weird week, and then another attempt to close below this low. Didn't happen. So this low held for 3 weeks, which to me said, if we were going to get a break of this low, it wasn't going to be catastrophic and drop us back down to here. That this wasn't another huge boom bust. That more likely this was a move that would scare some people, or test some support around 9,000. You got support here, you got support here, you got support all through here. All this 9,000 level looks pretty good, certainly that low. And then we'll see what happens. And then and this is what I was been saying for the last couple of weeks. Let's watch this 93.89 level last 2 weeks ago. If that held, because we were worried about this, and then when that held, we got a big rally up the next week, but it didn't close above this high, so this wasn't a reversal. It covered a lot of ground, but it's not a reversal signal. So therefore, when we get into this week, now we're staring at a reversal. We're staring at a classic 2-bar reversal, and within, but what still looks like a primary downtrend. This is still a primary downtrend. Low, high, lower high, lower high, low, lower low, lower low. But did we get that lower low this time? No, we didn't. So now it's going to be interesting to see what happens here as to whether or not Bitcoin can regain the 13,000 level or not. If it does, then this downtrend will be broken and we'll be back off to the races. And this is just a very volatile consolidation pattern between 13.5 or 13.8 or so and 9,000 on the low end, as the Bitcoin market tries to make head or tails what's going on in the quote-unquote real world. This is very encouraging. Is what this is. We had a retest of this low area. We didn't even approach this low, and then boom, we're back off to nearly 12,000 again. It's very interesting. Okay. All right, Brent crude. On Sunday, I talked about Brent crude. So this is crude oil, and I talked about it both from the weekly perspective and the monthly perspective, because the weekly chart was giving you all sorts of signals that Brent crude couldn't rally. I don't have it for you here, but you can review Sunday's market report if you want and see what I'm talking about. But I identified on Sunday, I said, look, we really need to watch for August a break below 59.45 here, because what that's telling us is that this is a primary bull market in oil, right? Up, higher high, low, higher high, higher low. These are all higher lows, right? And this could have been one of them. Now it's broken. This is no longer a potential low for a slingshot higher. It's not happening. We broke that. Now we're looking at $50 comes into play, or at least 52 and then 50. This area down in here is where we're going to be looking at this. And if oil breaks down to the low 50s here, then there's not going to be a whole lot of energy. It's going to be too much to overcome to even get this thing back to anywhere towards $90. So from my perspective, 50 is going to wind up being the marginal line as to whether or not this is going to set up for a new trading range in oil between $50 and $70 a barrel, which is my base case thesis, right? I thought $90 was way overdone. I thought $30 was way overdone. I know that the fracking industry in the United States needs at least $45 a barrel oil to even just remain, just to keep the ability keep drilling, and 65 on the upper end, because then too much supply comes in, and this is kind of what we're seeing now. And so now the market doesn't know what to do. Now that's WTI crude. Now Brent crude is the international oil standard that the 90% of the world's oil is priced against. Right, it doesn't matter what it is, and this will tell you what, I tend to look at Brent crude because I tend to be more internationally based than domestically based, and in my analysis, and therefore, Brent crude, international benchmark for oil, looking like a bear market here. I mean, it is a bear market. I mean, the 80 to 50 is a bear market. Biggest 3-month drop in the history of oil, by the way. Interesting that we got a 2-bar monthly reversal here, big 4-month uptrend, but then we couldn't break the high on this bar, and then immediately reversed that. Once this rally was done, it immediately reversed and went lower. And you got to remember, this is all amidst high tensions of war with Iran, and this stuff is continuing to go on. And this low here is the day after Trump decided not to bomb Iran after shooting down the drone. So, and we've now broken that, and we're moving lower. Why? All the things that Donald Trump is doing, all the things that the Chinese are doing, all the things that the central banks are doing. At the end of the day, this is the trend. Deflation is here. It's happening. Copper's in a bear market, oil's in a bear market, natural gas is in a bear market, gold is in a bull market, and so is silver. Because we're into the phase where the markets are beginning to handicap that the central banks are going to have to print a lot. And the central banks are telling you that they're going to print a lot. So, now what? And they're at the limit of which they can print. So now what? Well, confidence gets lost and people start moving into tangible assets. This is part of the reason why silver's starting to play catch up. And silver's doing so as playing catch up because silver's rapidly becoming an industrial metal and not a monetary one over the course. And that transition will probably complete itself over the course of the next half decade to decade. Certainly by the end of my life, silver will no longer be considered a monetary metal because there's just too many good uses for it industrially. And when that happens, that will destroy its monetary character. So history does not matter when technology breaks that history down. And that's what's coming in silver. And it's already in many ways here. But that being said, well, what's important here is I put this chart up a couple of months ago to tell you that while this was nice that we got a rally here in silver, and then we got a couple months ago I said, hey, look, we got a reversal. This is a beautiful straight up 1-bar reversal in silver. Closed above this high. 4-month downtrend, 1-bar reversal, boom. What was interesting is that we also broke the trend line in July, and silver closed above it, which was cool, but it didn't close above this horizontal resistance, right? Now we've gotten that push. So now that we have that push, these are your next price targets before we get to this, which is around 18.12 or so. And anything above a monthly close above $18, and I would honestly have to say that silver's back into bull market territory. And with gold pushing above 1,500 and looking like it's not going to pull back now, there were real worries about that because the silver to gold ratio was getting really stretched. But again, a lot of the conventional analysis in this, including guys like Martin Armstrong, who I absolutely respect, even though I disagree with him I disagree with him on certain things. We're talking up the silver to gold ratio and trying to talk down the gold bull market. And as a matter of fact, Martin was in his private blog the other day was trying to move the goalpost on gold and say, hey, we still have to get above 1575 before we can really call this a bull market versus the dollar. I'm like, Martin, I thought it was 1375. Then I thought it was 1484. Now it's 1575. It's like every time you keep moving the goalposts here. How about you're climbing the wall? Gold is climbing the wall of even your worry. It's a bull market. We're up 50% over the 2016 low. It's a bull market. By any rational definition, gold is in a bull market versus the dollar. And it's making all-time highs against every other currency in the world. There's being conservative in your estimates and being conservative in what you think, and what you're conservative in your forecasts. And then there's just being churlish. Call it a bull market and to say it's not the next big bull market yet, but it's in a bull market. It may just be a counter trend rally within a primary, within a medium term bear market, within a larger term bull market, but it's still a bull market. Silver, on the other hand, has a lot more technical work to do. It needs to get above $18. I'd probably feel better if it was above 21, because that was really where the breakdown was. I don't have that. Obviously, the chart doesn't show this, but we'll start with 18, and we'll move from there, because 18, I think 21, I think actually is the post-Brexit high, if I remember correctly, but don't quote me on that. Look at the chart yourself. Trust but verify. All right, but silver looks good here. Moving to $17 is great, and if they start to lose control of this above $13.55, this thing will move to $17.35. This thing will move to $17.70 and $18 very, very quickly. There's no doubt that once silver starts moving, it will move quickly, and it will light your hair on fire, because it's got a lot of catching up to do. And gold at 1,500 is now telling a lot of people, hey, silver is really, really cheap. And so retail investors looking for a place to park their money during times of unrest. Once gold gets too expensive, silver always catches up. There will come a day when that will not be true, but for right now, it's still true. All right, and the last thing to talk about today is the Dow. So the title for this slide is When Will Credit Step In, or Will Credit Step In? And that refers back to an interview that I watched with Brian Reynolds, a very strong credit fund manager and a credit analyst, a couple of months ago, where he was explaining the dynamic of how we're still in a virtuous credit cycle here in the United States, because pension funds are still desperate for 7.5% yield, and they'll get it, and they'll take it anywhere they can get it, even if they have to go into the junk bond, corporate paper market to get it. Right? Case in point, every one of these massive drop and then reversals in the Dow and the S&P, but really just the equity markets in general, his thesis is that that's just the credit markets waiting and waiting and waiting for max pain, because they don't need the pension funds and effectively the credit markets to step in and go, oh, look, stocks are cheap, and then they come in and they buy like with both fists and send the index higher and make their 7.5% vig by, in effect, almost goosing the market higher. They sit down with all of their money coming in on a monthly basis as people pay into their defined benefits packages, and then they just deploy that at times of max stress in the market. It's very smart for them to do it that way. It's very, in effect, very safe, relatively speaking. But it's what they're doing. And so, is this our next iteration of that? We got one here, we've got one here, we've got one here. Is this the next iteration? Look at where we are. Look at where we were on Monday, and now look at where we are today. If we got to close above 26, we got to close above 26,000 or even 26.5. If we got a continued rally in the Dow and this bar goes up for the week, forget it. That's exactly what's happened. And while I'm not going to tell you that I'm expecting new highs in the Dow anytime in the next couple of weeks or anything. If they are, they're going to be shallow, just like we had this one. We had a high here and then another high here. What do we move up? A couple hundred points? All this work for 200 points? It's not a lot. But there's money to be made if you're positioned properly, and and it's still levitating these markets higher. And as confidence is lost in the central bank's ability to manage all this, and I think it's very obvious that that's the phase into which we are heading, while the governments, play out their psychodrama as to who's going to export the most. What else is new? Clueless politicians always fighting the last war. The move is going to be into tangible assets. The move's already been into tangible assets. The Dow is 27,000, 26,000 because of this move into tangible assets. Moved into equities because there's still good yields to be found in certain U.S. blue chips, and they're liquid and they cross border, and you can cross borders with a stock portfolio. You can leave the European Union and come to the United States and get your wealth. Can't do that with gold. You can't walk out of. You can't walk out of an airport in Paris and take 20,000 gold, 20,000, 30,000 euros worth of gold and bring it to the United States. Start a new life. They won't let you. Same thing here in the U.S. They won't let you. Got news for you. Ain't happening. That's why Bitcoin is up. That's why stocks are up. They're movable, they're liquid, and they're fungible, and they're tangible. Because when the sovereign debt gets blown up, you'll get nothing. the very least, when you're a creditor of a company's got assets, got property, plant, equipment, branding, supply chains, all this stuff. It's tangible. Maybe only be worth 10 cents on the dollar, but it's better than being worth zero. And that's the mentality. That's what's going to be. That's what's going to take over the markets in 2020, 2021, 2022. I'm absolutely convinced of this, and we're at that position. We're at that moment right now where this is the phase that we're heading into. All right. This is how the portfolio is set up to take maximal advantage of that. All right. So the Dow looks weak here, but again, watch the numbers. Keep your, just because you've got a thesis doesn't mean you're right. Let's watch this play out. If we got to close above 26.2 or something like that. I don't have a number for this. This is going to be a feel thing. The next couple of weeks in the Dow are going to be critical. Does this low hold? This is going to be the question we're going to be asking for the next couple of weeks. Does this low hold? And if it holds, then higher, low, higher, low, higher, low, high, higher, high, higher, high. Yeah, it's not symmetric, but whatever. Could also just be building a base and then, slingshot the 40 grand. Because right now the sovereign debt markets are completely and insanely overvalued. The first move is everybody moves into treasuries and they move into safe haven bonds because that's where they think they can get there. That's where they think they're safest. They still see stocks as risk assets. Wait until the shift in sentiment and the shift in perception of when central banks people lose confidence in central banks, they're going to lose confidence in the government, they're going to lose confidence in the sovereign debt, and all of a sudden that's not going to be a risk-off asset, that's going to be a risk-on asset, and equities will be a risk-off asset, and that will and they will rise right lockstep with gold, silver, Bitcoin, and equities. And it's a once-in-a-lifetime event. It doesn't happen all that often. Conventional wisdom will get you killed here. This conventional wisdom is right when everything is normal. But eventually the lies and the inconsistencies of the intellectual models on which our economy is built, Keynesianism, Samuelsonism, monetarism, all that stuff, they're all lies. They're all false. But if everybody believes it, they can construct a reality that's metastable for, a couple of decades. And everybody gets used to it. They think that's the way it's supposed to be. Remember, nobody under the age of 55 in the United States has ever traded a bear market in U.S. Treasury bonds. U.S. equity, the U.S. bond market has been in a bull market since 1982. 1981, 1982? Since Volcker raised the prime rate above 20%. This generation of bond traders, 2 generations of bond traders, have never witnessed a bear market in U.S. Treasuries. They don't know how to trade it. They don't know what to do. It's not part of their mindset. It's not part of their experience. So imagine what's going to happen. Trade a little minor bear markets, but nothing major. No structural, huge bear market. All right. All right, this was a little educational, probably a little long, but like everything else, you got to do this every once in a while. It was actually kind of fun, so I enjoyed it. I hope you did. We'll talk again on Sunday, and we'll do this all again. You guys take care. Be well, and keep your stick on the eyes.